Well, holy smokes, everyone. What another wild day it was today in the markets. And the kind of crazy volatility we're seeing in the markets right now is not healthy. And what did we see yesterday? We saw the biggest single stock crash in US history. Facebook losing $230 billion of market value in one day. This has never ever happened before in history, everyone. So this should ring alarm bells in your head, and this should be time to be like, wakey, wakey, things definitely aren't looking good. We also got some huge economic data today that's showing what's happening with inflation and people. This is what absolutely spooked the market today. This is absolutely what spooked the bond market today, and things are about to get even more wild. So everyone, let's not waste any time. Let's get straight into the news, the facts, and the data. Okay, firstly, I just want to quickly comment on what's happening with Europe. We're seeing Europe absolutely enter into a huge crisis right now with gas prices surging, and this is now starting to weigh down on the European stock market. We saw the Europe Stock 600, that's 600 of major companies in the European Union. That fell again today after the decline yesterday of around 1.6%, and it fell around 1.48% today because Christine Lagarde, the head of the European Central Bank, finally admitted that inflation is not transitory and that the risks are tilted to the upside. But most of my viewers are American. They probably don't care about the European market, but you should pay attention to what's happening globally. Look at this. The Dow Jones Industrial Average was pretty much flat today, just down 0.6%. But the fact that we didn't get a big rebound today, that we still are in a bearish downtrend here. Now, the indexes didn't drop today, but there's a reason for that, which I'll get into later in the video. The S&P just up 0.5% today. And this just came up as I was recording this. It looks like Peloton stock jumps 34% on report Amazon is a potential buyer. And we saw the NASDAQ rebound today, up 1.5%, but it still didn't recover its losses from yesterday. So again, you may be looking at the indexes today and think, okay, the stock market was doing great. But really, it was only one company that held up the index today. And you have to know how these companies are weighted in the index, because one large cap company can move the whole index. So let's have a look what moved the index today. It was this, everyone, Amazon. Amazon jumped 13.5%, but I don't think these gains are going to continue. You can see in the after hours, it's pretty much flat. So it's not going to be there to say the indexes next week, because this is how the indexes work, everyone. Look, Amazon is number 3 in the NASDAQ, and in the S&P 500, it's number 3 as well, and has a weight of 3.9%. So that's why we've been seeing over the past few months, and why I've been warning that the stock market is already crashing, but it's only a few of the large cap stocks that are holding the indexes up. But now what you're probably wanting to know is, okay, but what happened with Bitcoin and why did it moon so much today? I don't know about you, everyone, but I've seen these kind of moves before, and this seems like nothing but manipulation. And remember, in downtrends, in bear markets, you're going to have rallies, and you're going to have whales come in and try to pump up the price. Retails will think we're back onto the moon. The moon boys will come back out with all their Lambos, and people will FOMO back in. But there was no real fundamental reasons why Bitcoin should have rallied today. I think this is just pure price manipulation and a possible short squeeze. Because look at this chart, everyone. We can see there was a total of 193 million short positions liquidated. And see the green lines here, those are long positions. And the red lines here, those are short positions. So we can see there was a spike in short positions liquidated, and it's what caused the short squeeze and the price to spike today. But people, we have to talk about what happened in the bond market today. Now, most people don't look at the bond market or pay too much attention to it, but you have to pay attention to what happened with the 10-year US Treasury today and what it's telling us. Look at this, everyone. After we got the jobs report, and I'll get into deeper why it spiked, look, it went from 1.81%, yield spiked all the way up to 1.39%. This is the highest yield we've seen in the 10-year US Treasury note since 2019. And what's this going to lead to? We're going to see record 30-year fixed rate mortgages, and this is hopefully going to cool down this crazy housing market. But again, the reason why the yield spiked in the 10-year US Treasury today is because investors realize, okay, they've been saying inflation is bad. We know that's bad. They've been saying, okay, eventually it'll go down. But people, we just got some huge economic data, some huge economic news today that shows inflation is actually now going to get worse. And so this is why investors are selling off bonds, because that means the Federal Reserve is going to have to lift interest rates faster, and they're going to have to sell off more of their balance sheet. Because look at this, everyone. Gas prices climbed to their highest level in more than 70 years, and oil surges above $90. And Brent crude oil actually hit $93 today, and I think it's just a matter of weeks before oil hits $100. But this is not all. Now I'm going to get into the most important piece of information that we got today that shows inflation is going to get worse. And people, you may think, oh, boring, inflation, I'm sick of all this economic data. I just want to know what's going to happen with my stocks. Well, people, if you want to know what's going to happen with your stocks, if you want to know what's going to happen with Bitcoin, you need to know what's going to happen with inflation. Look at this, everyone. Payroll shows surprising powerful gain of 467,000 jobs in January. But the single biggest key information we got in this report that spooked the bonds market and is going to make the Federal Reserve have to lift interest rates faster. Wages surged 0.7% for the month and are up 5.7% for the year. That is absolutely crazy, everyone. 0.7% in 1 month. When you annualize that and compound it, that's over 9% annual increase in wages. And it's higher wages that can make inflation more entrenched because then consumers, they say, can somewhat afford the higher prices. Now, just a quick side note here. I think it's quite funny how the Federal Reserve and central banks, they don't worry about inflation when asset prices are going up, when home values are going up, when consumer prices are going up. But when people actually start earning money, when the peasants actually start earning a better minimum wage, well, then the central banks go, no, we can't have that. We need to do something about this inflation. Which is kind of just laughable, but it is true. It does make inflation more entrenched. So everyone, but you're probably wanting to know is, okay, what does all this mean in simple terms? What this means is we've had a very mixed earnings season in the stock market. A lot of companies did terrible. A few of the large caps did great, and that helped lift up the indexes. And so that was some good news the stock market had to look forward to. But now earnings season is over. Now inflation is getting worse. Now we're going to look at this next CPI data and what the Federal Reserve is going to do. And to me, I don't think there's much good news left. And so I think this stock market sell-off next week is going to get worse because we're not going to see these huge rallies in the large caps from these earnings next week. So again, I'm still waiting patiently on the sidelines, building up my cash position, waiting to come in and buy up the mega dip. But everyone, what do you think about this? Let me know. Now, for all my loyal viewers and subscribers still watching, you're awesome. Thanks for watching. I'll see you in the next video.